here, if the dollar continues to strengthen and you know the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. First target is going to be back. So we are at a little bit of support per the chart. So you can see we bounced off these pivots right here. All right. And that's going to be a short-term little bounce. And then eventually we're heading back to basically just below 1,000, the double bottom. And then if I'm right that Bitcoin is headed to 12 to 13,000 and maybe even below, then I got to think that Ethereum could easily be headed down to, 700, 600 area. Yeah. So you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin. So to be fair, I know enough from my career to know that I don't pick exact lows. Yeah. And so basically in the teens, I'll be already starting to accumulate all the way down below. So basically, you see 16,000, I'll pick up a tiny bit, 13, I'll pick up a little bit more, 10, all the way down there. And the idea there is, I do believe that eventually Bitcoin's 100,000, 500,000. And so I'm not going to try to pick a bottom and miss it. Instead, I'll just dollar cost average in this lower range to build that core position. Yeah, I did buy back down there. Absolutely. Yep. Absolutely. So again, I don't know if it would be called with both hands and feet at that point, but I certainly did pick some up. That's the thing that investors need to understand is that every time you get a new candle on the daily chart, it's a new piece of a puzzle. And a good technician is going to go and look and say, okay, does this change my thesis? Does this change anything? And really what we've seen is the Fed's gotten more hawkish. The economic outlook for me is even more bearish based on the Fed being more hawkish, and that you have to start lowering asset prices even more. No, I think that's right. I think you want to look for a Fed pivot. The Fed pivot will be positive in the near term for risk assets, including Bitcoin. And I think that's where you start to nibble. I'd strongly encourage your friend to kind of not go all in at that level, but instead just dip a toe in the water. If it drops a little bit more, do another toe, kind of do that. Because again, we just don't know, remember, Bitcoin's only been around for now 13 years. It's a baby of an asset, and we just don't have enough data to really know for sure how it's going to behave. Yeah, so no doubt I've been disappointed in gold, even though it has been, I was correct that it is the best performing asset between the S&P and Bitcoin. But needless to say, I think it's down 6-7%, whatever it is for the year at this point. And I think overall we have to look at the strength in the dollar, right? So if someone told me the dollar was going to be up 17%, which I think is around what it is for this year, I would have said, okay, gold should be down 17%. Well, it's only down, let's say 7%. And because of that, I think that's showing relative strength. It doesn't make my portfolio happy to be involved in gold, but at least I guess I can look myself in the mirror and say, well, glad I wasn't all in Bitcoin with that money or in stocks. So I think overall, once you get a Fed pivot as well, once that dollar starts to come in, look for gold to really start to kick into gear. Also, if you happen to be trading gold in euros or yen, you're loving gold this year. It just happens to be because the dollar's strength that it's been underperforming. It's the same thing that happens in when COVID hit in March of 2020 and panicked everyone. You saw risk assets sell off, you saw gold sell off, you saw crypto sell off. And so there's a point where you start to get closer to a bounce in a stock in the markets, and this could be any market, where people are just throwing everything out the window. And I think that's what we're seeing today is you have interest rates that are just freaking people out. The dollar just keeps ripping up. That's freaking people out. And people are just saying, you know what? I'm exiting everything at this point, and I'll ask questions later. Now, we will probably see things like gold start to recuperate faster like we did during the COVID collapse, but that's what's happening right now. People are just panicked. This is the first day I'd say where I'm actually sensing that panic in investors, and that means we're getting closer to a technical bounce. From right here, I will take up because I do think the dollar is extremely overbought. So I'll take up from here. But again, you know, I don't necessarily know by how much. Could be 2% for all I know.
Why do you think the dollar's overbought, considering that you think that the Federal Reserve is going to continue its hawkishness? If interest rates continue going up, wouldn't the dollar follow?
Yeah, so that's the idea. I'm just a believer that the Fed has now hiked. I think it was a 50 basis point, then 375 basis point hikes. And there's going to be a point where they break the economy, and we're going to start to see it in some of these economic numbers. I don't know if it's the jobs number or if it's the next CPI number or what it is, but there's going to be a point where the economic data weakens, where the markets start saying, you know what? We don't think the Fed will raise as much as expectations are telling us. And that's that pivot where the dollar starts to roll over. I wish I could be more optimistic, but it's a scary time right now. And again, Absolutely. if the Fed had bullets in their gun to get us out of an issue, I wouldn't be so worried about it. It's like, okay, well then they could come out and print again. But I do worry that we're going to see that protracted bear market, like long-term bear market. And I do think that's going to be an issue for people and for unemployment for the longer term. Basically I'm at a point in my career where I'm kind of winding down a lot of my stuff. And this was kind of my one big last project where it's about 20 hours of educational content. Everything I know is in this, from kind of the analysis of mentality and psychology of human investors, all the way to setups and strategies and even my secrets. So it's here for people. It's hopefully one of the things I'll leave in my legacy when I kind of exit this arena. But it's truly good. And again, the website verifiedinvestingeducation.com. Yeah, and you're right. I mean, 5% by no means is good, but it would be nice to see it get back there at least. And I think what you're going to see is right. So we know that it takes time for lower energy costs to be passed through. So it's going to take a little time for that to filter through. And I also think the supply chain is slowly going to loosen up, right? It just takes time. It was a shock. The Russia invasion was a shock. A lot of these other things were shocks. But over time, businesses will expand their output of various things to compensate because prices have gone up. And if price goes up enough, it makes a business want to expand and make money off of those products that they sell. So I think those will alleviate and bring us down to 5%. I think as early as next year will be 5 or sub 5, but it's going to then be the last leg of the marathon is going to be the toughest. Yeah, so to me, it makes perfect sense. I mean, think about 2021 when money was free and the government was sending out checks to Americans nonstop. And so there was just so much liquidity and money in the system that a ton of it wound up in the stock market, buying tech stocks, these tech stocks that had no earnings, that were trading at crazy multiples to revenue numbers. And now you're seeing this kind of suction. It's almost like a vacuum sucking the liquidity and the money out of the system through higher interest rates, through quantitative tightening, QT, and that's going to just bring down these asset prices. And we've seen, I mean, amazingly, like a stock like Roku down from what, 500 to like $60, kind of, I mean, incredible type drops in these assets, but it makes a lot of sense since the money is getting sucked out. There's not as much money to go around to so many stocks now.